Stock trading is the act of purchasing and selling stock in a corporation. If you possess certain stocks and shares in a corporation, you effectively own a piece of the company. A stock trader is a professional or an individual who trades on behalf of a financial firm. Stock traders can be divided into three groups: informed, uninformed, and intuitive traders. Swing traders, day traders, momentum traders, and buy and hold traders are some of the most common traders. Let's have a look at stock trading. There are two main types of stock trading. Trade actively. It's what happens when a trader makes 10 or more trades per month. Typically, they employ a strategy that significantly relies on market timing, attempting to profit from short-term developments in the coming weeks or months. Trading on the same day. It's a tactic used by investors who play hot potato with stocks, buying, selling, and closing positions in the same stock on the same trading day, with little regard for the underlying firm's inner workings. The goal of a day trader is to profit from daily price movements in the next few minutes, hours, or days. What are the benefits of investing in stocks? Individual traders will use a brokerage or an agent to purchase and sell. Institutional traders, on the other hand, are generally employed by investment firms. Stock traders supply liquidity to the markets and define their tactics using a variety of methods and styles. Stock traders aren't the same as stock investors. Stock traders deal in equity securities, whereas stock investors buy them with their own money. The fundamental purpose of a stock investor is to earn interest or profit from an increase in value, commonly known as capital gains. The basics of stock trading. Stock trading is a type of investing in which short-term earnings are prioritized over long-term advantages. It's dangerous to jump in without knowing what you're doing. Stock trading entails purchasing and selling company shares in order to profit from price fluctuations on a daily basis. Stock traders differ from regular stock market investors in that they use a short-term approach rather than a long-term one. While stock trading can result in quick profits for those who time the market perfectly, it also entails the risk of large losses. A single company's fortunes can rise faster than the market as a whole, but they can also fall faster. Individual stocks are often not recommended by financial advisors unless the investor has enough money to lose. To learn how to trade stocks, you don't have to work on Wall Street. Online brokerages have enabled you to trade stocks instantly from the comfort of your own home or on your smartphone. However, before you get started, make sure you understand how the stock market works, the best stock trading applications, and how to limit your risk. How to manage the risks of stock trading. These 4 stock trading strategies can help you trade stocks securely, no matter where you lie on the investor-trader spectrum. Maintain accurate records for the IRS. Taxes on investment gains and losses might be tricky if you're not utilizing a tax-favored account, such as a 401k or other employment plan, or a Roth or regular IRA. For different sorts of traders, the IRS has varied laws and tax rates, as well as different forms to file. Another advantage of keeping detailed records is that losing investments can be used to offset income taxes through a clever approach known as tax loss harvesting. Reduce risk by progressively establishing positions. With any position, there's no need to plunge into the deep end. Buying slowly reduces an investor's exposure to price volatility. Don't pay attention to hot tips. Your buddies aren't the people who post in online stock picking forums and pay for sponsored commercials pitching sure thing stocks. They're often part of a pump and dump scheme, in which dishonest characters buy large quantities of shares in a little-known, thinly traded firm and then use the internet to hype it up. The fraudsters pocket their profits, dump their shares, and send the stock careening back to earth while unknowing investors buy up on shares and drive the price higher. Don't assist them in filling their coffers. Where should you trade stocks? You'll need a broker to trade stocks, but don't settle for just any broker. Choose the one that has the phrases and tools that best suit your investment style and experience. Low commissions and quick order execution for time-sensitive trades will be a bigger priority for active traders. New traders should seek out a broker who can teach them how to use the tools of the trade through educational publications, online tutorials, and in-person seminars. The quality and availability of screening and stock research tools, on-the-go alerts, easy order entry, and customer service are all elements to consider with stock trading applications. Whatever the case may be, the time spent studying the foundations of stock research and experiencing the ups and downs of stock trading is time well spent, as long as you're having fun and not putting any money on the line that you can't afford to lose. Investing in stocks. If you're new to stock trading, keep in mind that most investors are best served by keeping things simple and investing in a diversified mix of low-cost index funds in order to achieve long-term outperformance. Create an investment account. Stock trading necessitates the opening of a brokerage account, which is a sort of investment account. You can start an account with an online broker in a matter of minutes if you don't already have one. But don't worry, just because you've opened an account doesn't imply you've started investing. It simply allows you to do so when you're ready. Make a trading budget for stocks. Even if you develop a knack for stock trading, investing more than 10% of your portfolio to individual equities exposes your money to excessive volatility. This, however, is not the only risk management guideline. The following are some more do's and don'ts. Only put your money where you can afford to lose it. Use money set aside for immediate, must-pay items like a down payment or tuition instead. If you don't already have a good emergency fund and 10% to 15% of your income going into a retirement savings account, cut that 10% down to 5%. Learn how to place market and limit orders. You can utilize your online broker's website or trading interface to place stock trades once you have established your brokerage account and budget. You'll be given a number of order types to choose from, each of which will affect how your trade is processed. There are two most popular categories. Order of the market. Buys or sells the shares as soon as possible at the best price. Limitation of the order. Only buys or sells the stock at or above the price you choose. The limit price for a buy order is the highest you're ready to spend, and the order will only be executed if the stock's price falls to or below that amount. Use a virtual trading account to practice your skills. Virtual trading tools provided by several online stockbrokers provide investors with hands-on, low-pressure experience. Customers can practice trading and create a track record using paper trading before risking real money. Maintain your viewpoint. Finding the next big breakout stock before everyone else isn't required to be a successful investor. Thousands of skilled traders have undoubtedly already heard that a stock is poised for a surge by the time you hear it, and the potential has likely already been priced into the stock. Even if it's too late to earn a quick profit, it doesn't imply you're too late for the party. Great investments continue to provide shareholder value for years, which is a compelling justification for approaching active investing as a hobby rather than a last-ditch effort to make quick money. Compare your results to a suitable benchmark. This is critical guidance for all investors, not just active ones. The ultimate goal of stock selecting is to outperform a benchmark index. The Standard & Poor's 500 Index, the NASDAQ Composite Index, or other smaller indexes that are made up of companies based on size, industry, and region are examples. If a serious investor cannot outperform the benchmark, it makes financial sense to invest in a low-cost index mutual fund or ETF, which is effectively a basket of companies whose performance roughly resembles that of one of the benchmark indexes. Thank you for joining us. Hope you will have a beautiful day.